The internal rate of return is a metric for determining the potential profitability of an asset pool. Higher IRRs are typically set for value-add portfolios and distressed portfolios, whereas investors can expect lower IRRs for core or core plus based assets. In terms of what a promote fee might look like, if an IRR is between 0 and 10%, then an asset manager should expect the shareholder distributions to be made 100% to the shareholders on a pro rata basis. It's important to point out here that this includes the 2% or the 5% investment that the asset manager makes. So any promote fee that is payable to the asset manager is very much in addition to any returns it might make as part of its equity contribution. Similarly, if the IRR is over 10%, then a 90% distribution to shareholders can be expected, with a 10% promote fee being available to the asset manager. Over 20% of IRR might mean a 20% promote fee, and over 30% might mean a 30% promote fee, with consequent reductions in the shareholder distributions accordingly. If there's debt finance in place, it would be typical for there not to be sufficient leakage to equity in order to permit the payment of that promote. So payment of promotes on refinancings are common. Likewise, if there's been a staggered sell down of a portfolio, an asset manager may expect to receive its promote fee at that time. Or if sales haven't progressed in accordance with a business plan, or the exit strategy hasn't been adhered to, then there may be a deemed distribution in order to cover the promote after a specified number of years. The asset manager should be aware, though, that it would be typical for the promote to be switched off if the asset management agreement is terminated for cause. This would include a situation where there's a material breach of the joint venture agreement or the shareholders agreement, which then led to a cross default of the asset management agreement. Likewise, if the asset manager is insolvent or fails to perform its obligations under the asset management agreement, it can expect not to receive its promote fee. Or if a key man event has taken place, meaning that certain specified personnel that are contracted to provide specific services under the asset management agreement on behalf of the asset manager, if those services fail to be provided because the key man no longer is employed by the asset management company, then in that circumstance, the promote may also be switched off.